If you're following our Global Economic Outlook series, hit subscribe to stay updated with new country releases. Peru's economy shows stability in Q2 2025, not a boom, not a collapse, steady growth and resilience. GDP tracking close to 3% in Q2, unemployment easing modestly in mid-2025, inflation near target, interest rates supportive. First, external headwinds from global commodity cycles. Second, commodity price swings affect export revenues. Third, social disruptions can temporarily slow activity. Fourth, policy shifts may influence investor confidence. Fifth, household income pressures can limit consumption. Yet the headline metrics tell a more balanced story. Investors should weigh risks against steady macro fundamentals. Let's dive into the data driving that view. A recovery trajectory has been in place since 2024. Next, labor market shifts have been gradual and positive. Fiscal indicators point to manageable debt levels. Key sectors like mining and agriculture support demand. The central questions: sustainability, inflation, external risk. We frame decisions for investors, risk versus return. Now, a focused data dive on each metric: GDP, unemployment, interest rates, inflation, debt. We'll show trends, annotations, and implications for each. Begin data dive, starting with GDP performance and projections. We'll keep visuals crisp and annotated for clarity. GDP first, growth near 3% in Q2 2025. This follows a recovery that began in 2024. Q2 2024 expanded by 3.6% year-on-year. Estimates show months in early 2025 supporting Q2 strength. Now, an intensive data storm in the next section. GDP growth near 3% in Q2 2025 reinforces stability. Q2 2024 recorded 3.6% year-on-year growth. May estimated increases of 2.4 to 2.6%. June showing above 4% in some series. Mining contributes strongly to overall output. Agriculture and domestic demand support steady growth. Private consumption remains a key driver. Investment shows selective recovery across projects. Exports trend with commodity movements. Monetary policy supports activity through moderate rates. Benchmark interest rate near 4.75% in early 2025. Inflation remains within the central bank target band, about 2%. Government debt near 33% of GDP, manageable by historic standards. Unemployment eased to roughly 6.1% in the May-June-July quarter, a decline from 6.4 to 6.1 in mid-2025. Annual estimates for 2024 were near 4.83%. Social disruptions in July could slightly temper future figures. The central bank expects anchored inflation and steady policy settings. Lower borrowing costs support private credit and investment. Prudent fiscal targets aim to reduce the budget deficit over time. Taken together, these indicators show coherent stability. Growth without overheating is the central takeaway. Labor absorption is improving across sectors. Consumer demand remains a key support pillar. External factors like commodity prices still matter. Summary: GDP up, unemployment down, inflation anchored, rates supportive. Risks are present but broadly manageable in this profile. We rely on the metrics included in our briefing. All metrics together indicate stability without excess inflation. Next, 3 case studies illustrating real dynamics. Q2 aligns with broader projections for steady expansion. Consumer confidence shows gradual recovery signals. Business sentiment is cautiously optimistic. Expectations remain anchored near the target. Rates remain supportive given stable inflation outcomes. Participation and workforce engagement are improving. Construction activity supports employment and investment. Export markets remain important for growth stability. Corporate balance sheets look resilient in aggregate. Retail sales support the recovery in domestic demand. Exchange rate conditions have been rated stable overall. Debt levels near 33% help preserve fiscal space. Prudent fiscal targets are part of the stabilization story. Targeted investment in key sectors remains visible. Labor market improvements are incremental but meaningful. Monitoring social and external risk is essential. Central bank forecasts suggest full-year growth near 3.1%. Different institutions show cautious optimism within a similar range. Headline metrics line up to indicate moderate, steady expansion. We'll now examine 3 real-world examples to ground the numbers. Summary complete, moving to concrete cases. Case Study 1 starts now. Case Study 1, a mining investment and regional employment effects. Investment in mining supported both output and jobs in 2024-25. Local employment and services benefited from project activity. Case study 2 follows. Agriculture demonstrates resilience through domestic demand cycles. Value chain activity supports both rural employment and exports. Case study 3 is a services and consumption example. Retail and services recovered as consumer demand steadied. Case study 1, mining investment supported Q2 output and local employment. Spillovers included services, transport improvements, and jobs. Employment gains reinforced domestic demand in surrounding regions. A caveat: mining depends on commodity prices and export cycles. Takeaway: sectoral investment can materially strengthen growth. Case study 2, agriculture provided steady export volumes and rural income. Rural employment supported consumption and investment in local markets. Value chain expansion strengthened both domestic supply and export capacity. Policy incentives helped maintain agricultural momentum. Takeaway: agriculture adds resilience through diversified exports. Case study 3, services and retail responded to improving consumer confidence. Small and medium enterprises captured much of the early recovery. Household spending patterns supported sustained, if moderate, growth. Takeaway: domestic demand can stabilize overall growth. Together, these cases show how sectoral balance underpins macro stability. Timelines show investment, harvest cycles, and service rebounds. Location tags denote regional impacts in our examples. Each case contributes to the national stabilization picture. Mitigants include policy tools, fiscal space, and sectoral diversification. We now connect these patterns in a concise analysis. Recap: mining, agriculture, and services each bolster growth in different ways. For investors, sector selection and timing matter. Diversification across sectors can help manage cyclical risk. Liquidity management remains an important tactical focus. Overall, case studies confirm the moderate stability narrative. Next, connect the dots across metrics and cases. We examine interplay: demand, prices, policy, and debt. Policy has kept inflation anchored while allowing growth. Labor improvements feed back into consumption and services. Case studies provide concrete channels for these macro effects. This completes the case study walkthrough and implications. Analysis: how do these pieces fit for investors? Growth near 3% with inflation, around 2% signals balance. Policy trade-offs appear managed, with a bias toward supporting activity. Scenario 1, sustained stability with gradual improvements in employment. Scenario 2, an external shock could slow growth but fiscal space cushions impact. Suggested approach: diversify sector exposure and follow policy signals. Monitor social events, commodity trends, and inflation surprises. Near-term watch points include labor data and monthly activity indicators. Checklist: liquidity, risk limits, sector allocation, policy monitoring. Map: GDP tilde 3%, unemployment easing, rate 4.75%, inflation tilde 2%, debt tilde 33%. Implications: moderate growth with manageable macro risks, sector focus matters. Stay informed with timely data and scenario planning. In sum, Peru in Q2 2025 appears stable, balanced, and resilient. Now, a concise summary and a clear call to action for investors. Summary: GDP growth near 3%, unemployment easing, rates at 4.75%, inflation anchored around 2%, and debt near 33% of GDP. For investors, prioritize resilient sectors, maintain diversification, and monitor policy and social developments. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.